Hi, everyone. This is Jason Burack of Wall Street for Main Street. I'm here with trader Aaron Basile from Carnivore Trades. We wanted to do our annual 2023 review and 2024 preview today on Thursday, December 28th, 2023, here at night after market close. Aaron, want to get your thoughts on some of the major themes of 2023. We have one of the major narratives out there is the Fed is reducing its balance sheet by over $1 trillion with quantitative tightening. Was there actual net liquidity drains, though?
Officially, according to the official reports, yes. But we talked about this previously. We were talking a little bit about it before we started recording. But markets tend to go up on liquidity and they tend to go down on illiquidity, and markets have done an awful lot of going up lately. In fact, I know we talked about this previously as well. The BTFP, apparently it's not adding liquidity, sure. But, the day that program was announced and went into effect on March 13th was the exact same day that the markets put in a low earlier this year and stopped going down. Additionally, if you look in July, late July, that's when that long bond issuance really started hitting the market, started hitting the tape, sucking liquidity out. So there was some liquidity being pulled out, but right around the lows, a few days after we made the lows in October, Yellen adjusted the QRA, announced a new QRA, and pushed all that new issuance down to the short end of the curve. And again, that brought liquidity back into the market. I think that was leaked to the banks as the market started rallying before that. But right now it's hard to believe that there's any sort of real liquidity really coming out of the system. Either it's coming out of one end and somehow another hand is putting it right back, in another place. But markets are sitting right now. The SPX is sitting about 30 points away from all-time highs. The triple Qs, the NASDAQ 100 recently just made a new all-time high, as did the Dow. So it's hard to believe that there's a real lack of liquidity here. Financial conditions have loosened tremendously since late October. And this is kind of what they do. But they'll say one thing, and the markets will respond differently. And it's hard to believe these policymakers, when earlier this year we had two negative quarters of GDP, negative GDP growth, but that wasn't a recession, right? There's no inflation. The CPI is only 3%. So they'll say whatever they want to say, and they'll make the numbers say what they want us to see. But again, it's hard to believe that there's really a net liquidity being drained from the system at this point.
Yeah, I totally agree. It's all about shadow liquidity and controlling the narrative. As Jim Sinclair said, management of perspective economics and the Cantillon effect. So you have stagflate tax lie and the Cantillon effect. Like you said, the consumer price index, it looks like that's headed below 2%. Meanwhile, here in reality, for most Americans, they're dealing with a much higher cost of living. Their standard of living is being destroyed with stagflation, shrinkflation, taxes. The real economy, in my opinion, it's bifurcated. We're seeing this with the Christmas data, with a lot of the consumer spending. So if you're making hundreds of thousands of dollars per year and you don't have a lot of high interest consumer debt, and then you own a lot of assets, you benefited from this asset price inflation, the Cantillon effect. And the U.S. federal government and the state and local government, with all the different types of tax receipts, state and local government is about the property taxes and in sales taxes when consumers spend. But the federal government, it's about capital gains taxes on stocks, bonds, real estate, those types of things. We're just in a scenario post 2008. They cannot let the asset prices stay low for very long. And look at these shadow liquidity games. It wasn't just the BTFP, Aaron. It was also the FHLB. At one point, the banks, the regional banks, which are not marking to market all those office buildings, the insurance companies, the pension funds, they're not marking those losses to market. They're just hiding the losses. It's accounting gimmickry. It's technically not illegal. They don't, as long as they don't need to do a capital raise to go show their balance sheet to investors to raise additional capital. So they're not marking those losses. And then the shadow liquidity, they're tapping what the FHLB at one point, I think it got to 1.3 trillion. I'm not sure what it is now. I was trying to pull up the report before we start recording, but these shadow liquidity programs, if the Fed's reducing its official balance sheet, like you said, it's a shell game. It's coming in one or the other. And that's why you have the stock market at these levels and the real economy. A lot of these businesses, especially small caps up until the last month, those small cap businesses, a lot of them were relying on lower interest rate debt. A lot of their business plans were planning on using this artificially cheap debt to fund our growth project. But as the Fed was raising interest rates, it just didn't make any financial sense when you were doing the net present value with the cash flow projections and the debt borrowing. I mean, the capital cost to use debt to go and build, say, a liquefied natural gas project, the costs were up way over 3 times with the debt levels that raised so much with the Fed rate hikes, because everything is priced off the 10-year U.S. Treasury yield. A lot of people who are new to capital markets might not understand that, but a lot of the private sector debt is priced off the 10-year U.S. Treasury yield, which, by the way, Aaron, I would say we were going to talk about this too. The chart of the 10-year U.S. Treasury yield, it's literally a roller coaster, and it looks like a meme stock or a penny stock.
Yeah, I mean, at 2 months ago, we were at a 5% clip there, and we're sitting right now at about 3.8 on the TNX. So, and that's 2 months. I did read earlier today that was the best 2 months, 2 consecutive months ever for TLT. So impressive bond market rally here. I'm not so sure that this is going to last all that long. I heard a lot of the same things. I'm kind of a rate bull in the bigger picture here, and I think that we are in an inflation cycle, and this is not going to go away anytime soon. We have wars, we have commodity price inflation, we have deglobalization. These things lead to more wars, it leads to protectionism, which is also, then that leads to things like price controls, shortages, that type of deal. So I'm kind of a long-term rate bull. I think the market's way ahead of its gourd here when we talk about pricing in 6 rate cuts for next year, I think 175 basis points. And the market's rallying up on this. And if that's correct, and the Fed does cut 6 times, which the Fed's only projected to cut, the Fed themselves are only projecting 3. But if they cut 6 times, I promise you, the economy is not in good shape. So, the market's up on hopium right now.
Oh, yeah, I totally agree. And 6 rate cuts, I mean, something would have to break, Aaron. I mean, we'd have to see another Credit Suisse or larger, or insurance companies, pension funds. We'd have to see something big, sizable break and cause potentially contagion, which means like one bank fails or about to fail, and then counterparties. And this bank has to be sizable. So we're talking something.
And it would have to be quick too. It would have to be something that is rapidly unwinding. So it can't be something, I mean, everybody's looking at commercial real estate, and sure, that's going to be a problem. But I think, the Fed's not, they seem like they're stupid. They act stupid, but they know about this risk. So it'd have to be something more of like a black swan if that's going to happen. But I'm in the camp right now. I don't think inflation is going to go as low as the market thinks. I think there's secular inflationary pressures. That doesn't mean we can't have cyclical downturns, right? In the 70s, which is really all we have to compare this kind of period to. We had 4 recessions in the 70s from 68 to 82, but everybody remembers the 70s for inflation. So I think we can, the next big policy error here, and, it's funny, ironic, Jerome Powell talked about Arthur Burns. He doesn't want to be the next Arthur Burns. I think he's kind of be the next Arthur Burns. If they start cutting rates, you could get a bear steepener, rates coming back in on the short end with the long end. Inflation expectations remain anchored. And I think rates are going to surprise people in the first quarter, as I don't really see inflation getting as low as people think. So I'm actually kind of bullish rates here. Maybe they could go a little bit lower here. Again, we're kind of in the holiday period, and the bond market's kind of, got some momentum here. But I think that first quarter is going to be a little bit of a surprise to investors. And I think the market is going to come back to earth here as we get out of the holiday period, and you get kind of that, that participation to start coming back in.
So for people who didn't study the 1970s stagflation, like Aaron says, there was actually, the stagflation came in waves, and it actually happened to the Fed chairman before Arthur Burns and then after Arthur Burns with Volcker. So there was waves of inflation where they thought they had it tamed, and then the Fed took the foot off the gas pedal, stopped doing the rate hikes. I think they even did a few cuts here or there, or they just let the things plateau. And then you started to see what Aaron said. You started during the 1970s, there was also issues with oil and energy and workers demanding wages. You're seeing this now. You're seeing a lot of input costs for a lot of businesses and a lot of industries. Those input costs are still rising. There's still shrinkflation in a lot of businesses, especially food. Look at soft commodity prices. I mean, we're at or near all-time highs on a lot of soft commodity prices. So there's a lot of, I would say, supply side problems and higher input costs. For certain industries, there's higher wages. All these input costs are, and then higher cost of capital too. Because even though the rates have temporarily gone down, I mean, a lot of the private sector is still dealing with much higher rates relative to, especially compared to the last like 5 years.
Yeah, and another thing too that is for a direct impact on rates. We touched on the QRA earlier. Yellen, she kind of restructured how that debt was going to be issued in October, early November. A lot of it's going to have to come out of the long end this time, and she has to issue $1 trillion next quarter. Jason, they have to issue about $1 trillion each quarter next year. We're going to probably hit 40 trillion in debt. That is going to put pressure on long-term rates, it is going to pull actual liquidity out of the market. So maybe they'll have to come up some more new shadow programs, but I don't think rates. I think rates have a tailwind here, and again, that doesn't mean they can't control them to an extent, but I don't think they're going to be able to push them down, specifically not on the long end, the way that the market thinks that it's going to happen.
Well, no audit, no problem, Aaron. I mean, as long as Janet Yellen and the voting Fed governors, the doves that are backing her, that like Janet Yellen's policies, and a lot of them are Democrats and a lot of them are in favor of MMT, and they think that government's not spending enough. Government needs to spend more, Aaron. That's a problem. Government's not allocating enough capital. Government needs to spend more money. I mean, the Green New Deal, the 70% that was hidden in the Inflation Reduction Act months later, that was added in later, and that's one of the main reasons why Speaker McCarthy was fired. That was covered up, and I found that out from Republican strategists. I mean, it's just a disaster. But both political parties here in DC, they're talking about spending more. You have the Republicans and the Democrats team. They want to send even more foreign aid to Ukraine. I think the Pentagon just passed without Congress voting additional foreign aid packages. So it's just laughable. Welfare, warfare, state. This is like textbook from, if you study history, end of empire, whether it's the British Empire, the Roman Empire, Chinese dynasties, it's textbook end of empire.
And another thing too, I mean, if you think that, so if you're predicting inflation and rates to collapse because we're going into a recession, well, we're also going into an election year. Do you think that the incumbents are going to go into an election year and have a recession? Of course not. They're going to start stimulating. They're going to do the only thing they know how to do. They're going to force Yellen to issue more debt. I mean, this is a debacle right here. And more
government employee jobs, Aaron. More right. The last 12 months on the jobs reports.
And they've been able to get away with it for 40 years because we've had globalization, and now that's coming away. And these MMT guys and these long-term, bond bulls are figuring this out, or some of them are maybe figuring it out. I hope that there's a secular shift going on, and it's not the same market that it has been for the last 40 years.
No audit, no problem. The Fed's Janet Yellen's going to start. I was told this by people who party and drink and do drugs and all that type of disgusting stuff with the rich people here in the DC metro area that party with some of these elite people at the DC Fed, that Janet Yellen panicked over the summer and decided that she was going to do MMT, quantitative easing off balance sheet, and start monetizing debt then when the 10-year US Treasury yield hit 5. So she started to panic then, and it got worse. I think when Aaron said, we were talking about this before we started recording, in September, October. So she did it even more to knock yields back down on the 10-year.
Yeah, there was, I thought there was a chance that we could get to 5.5, which would be at parity with the Fed funds. But it seems their max pain was 5%. I knew that yields would likely come in. I was actually getting long bonds around that time and positioning myself. I didn't know we would rally this hard in bonds, but I thought the yields were getting a little extended, at least cyclically, but I don't think it's going to last all that long. I mean, remember in April, the 10-year was at 3.3 and everybody was calling for it to go back to 1. And then it went up to 5. So again, I just think that the market's getting a little ahead of itself here. And I'm not, I think that we're in a secular shift here. Honestly, I think that this period is very reminiscent of the 70s. And I don't really, that doesn't mean we can't have bull markets, we can't have bear markets, but I think you're going to get both of them, and you're going to have more volatility. And it's going to be a period where you're going to have to manage your money. It's not going to be good for passive income, and you're going to have to really do your homework if you're going to make money in this type of environment.
Yeah, I agree. Buy and hold on a lot of stuff is going to be very, very difficult unless you're buying really quality assets that have good balance sheets and good cash flow at low valuations. I'm in the Phil Zuloff camp, and he did an excellent interview with Adam Taggart about a year ago, and he was talking about just a roller coaster type of asset markets with volatility. I mean, the markets are hinging off everything the Fed says with the dot plots. I mean, the Fed's track record, Aaron, on inflation predictions, the Fed's track record on interest rates, 6 months, 12 months out, it's absolutely terrible. These are PhD economists with the track record of any terrible government bureaucrat. I mean, they were predicting, for reference here, they were predicting what in 2019 during the repo crisis that they were going to keep raising interest rates, no problem. They weren't going to blow anything up. And then the Fed panicked and started cutting rates. And then in 2020, when interest rates were artificially low again, what we were back down to around ZERP back then in 2020, the Fed was projecting in their dot plots that they weren't going to raise interest rates and inflation wasn't a problem. So the people that are citing, and we're just seeing this on business television, that there's a new bull market in stocks, the Fed has inflation under control, the Fed's going to do all these rate cuts. I mean, the Fed's track record for these types of predictions on the dot plots is absolutely terrible.
And the market is really no better. I mean, in I believe it was March or May, I think, of earlier this year, the market, Fed funds futures had priced in like, I think it was like 100 basis points of rate cuts by this September. Obviously, that didn't happen. The Fed hasn't budged. In fact, it kept raising throughout the summer. So, the market's not really any better. The bond market, these guys are mostly clueless.
Well, I think the bond market was trying to send them, it was like a taper tantrum. So the market was trying to say, we want the rate cuts, we want the rate cuts. So they were trying to speak it into existence. And then the Fed said no. And then the market like panicked and reversed. But here we are. I mean, like for 2023, the majority of stock gains in the S&P 500, you said that they were at or close to an all-time high or somewhere around there approximately. I haven't looked at the chart since we started recording, but the majority of the gains, Aaron, was the Magnificent Seven up until the last month or so, right? So the majority of gains, if you subtract the Magnificent Seven, the majority of S&P 500 stocks were what, 2% up?
They were not as of October, when the market bottomed, the equal weight S&P was down about 2-3% for the year. Then when we bottomed out, and now it is I'm off the top of my head, it's probably up 5-10% for the year. But it was not doing anything up until that October bottom. So,
and then we've rallied big. I mean, this is an enormous short cover. Anything that had a high short interest. So regional banks, commercial real estate investment trusts. Small caps. Anything that had a high short interest the last, 4 to 6 weeks, there's been an enormous rally.
Yeah. And here, right now, to kind of talk a little bit about what's going on in the equity markets into January, into quarter one, the rally that we've had, it's definitely close to historic. I think that's one of the best Novembers on record, and we've continued pushing up in December. We have not pulled back at all. That is about kind of, we're going to need to pull back here at some point, or we're going to need to digest this. Otherwise, this is the type of thing that could incur a volatility event. This sort of move here from October to now very, very much reminds me of December 2017 and January 2018, where we had Volmageddon, and the market was already rallying, and then it rallied like another 10% without pulling back. We had that big 20% drop. Again, I'm not predicting that we have a 20% drop, but if we continue up without correcting, you're going to have a move that's proportionate, right? If you rally 10, 20% and you pull back 50% of that, it's going to be a big correction. So I think at some point, if this market doesn't slow down, we could see something that, causes a vol spike. Puts are really cheap right now. The market is very one-sided. So that is, something that I could see being a danger around the corner as we get kind of into 2024, if this market doesn't cool off at some point.
It's definitely like a manic depressive, and the algorithms have turned on a dime. I'm not sure I've seen the markets go from risk off to risk on this quickly.
Right. I mean, was 2 months ago, it was at, the fear greed model was at extreme fear, and we're at already at extreme greed. I mean, and we're like I said, right now.
Did you see that chart of extreme fear? It's literally a roller coaster. I think I sent it to you.
Yeah, it looks like how it should look over like the period of a year, but it's a period of 2 months.
That is why it's the trading algorithms. Right? This is the trading algorithms, right?
Well, you're getting algorithms. A lot of what's happening too is, again, I think a lot of shorts were really off sides, and then you have end of year when you're up big, you're going to have new money flow coming into the market. That does make sense, but this has definitely gone a lot farther. I thought that we would go, I was talking about end of year rally too, but I thought we would go maybe, okay, 4,500, 4,600 SPX. I didn't think we would hit all-time highs by the end of the year. That was, much, much, much higher than I thought that this would go. And I didn't think, the NASDAQ here, the triple Qs actually hit all-time highs earlier last week. So, I thought maybe by January, but yeah.
So let me ask you then, why is it back to liquidity? Are we having all that net liquidity drained from money market funds, those short-term treasuries? Because I was interviewing really smart people over the last 6 months, and they were telling me about all the fund flows. It was going into short-term US treasuries around 5%, money market funds, basically risk off. So it was going into those types of things, safer stuff, the Magnificent Seven, gold, Bitcoin, which I would consider, because those are more liquidity stuff, especially if you're in a foreign currency that's being debased faster than the dollar. So those things were doing very, very well, those 5 or 6 things. But now are we seeing like net liquidity drains out of, say, money market funds and short-term US treasuries? Are they going into the risk on stuff? So the riskier stocks and the risk on stuff now?
I think there is some of that. There's definitely FOMO. So people are at the point where, like you said, like, oh, that's it. Rates are coming back down. The Fed's going to cut. So where do we put our money? We take it out of money markets and we put it into, okay, what hasn't gone up yet, right? We know Magnificent Seven has done well all year. But if you look at recently, Apple, Microsoft, Google, they haven't really, they've held up, but they haven't really surged as much as, right, the Russell 2000, right? People are going to look and say, like, what hasn't run yet? What's the next sector? So they're going to the things that are beaten down, the heavily shorted stocks, things that will do well in a low rate environment. The home builders are at all-time highs again. So that's where that rotation is kind of going to. Right now, it does seem Magnificent Seven is cooling off a little bit. And I think there definitely is something to be said that you could be seeing some money kind of come out of those money markets and into equities.
Even commercial real estate stuff, related stuff. So commercial real estate investment trusts. I'm just seeing tons of positive bullish articles that these businesses are going to refinance. All the losses are priced in. I'm like, whoa, wait a second here. I'm speaking to bankers and they're telling me like none of the losses are being written off yet.
You can't accurately price in losses or bankruptcies like that. That's not how it works. That's just, that's pretty remarkable that they would even say something like that. Now, narrative follows price, right? So if commercial real estates get these REITs are squeezing, then you're going to get people come out and say like, oh, it's priced in, it's all over, So narrative follows price, and the financial media will make up anything they need to make sense out of something. But I think it's a little ridiculous to think that the market would be able to price. We're talking about, if they didn't have backstops, we would be talking about mass bankruptcies, right? So there's no way for the market to actually price that in.
Oh, a large amount of the regional banks would have failed already if there was no BTFP and there was no FHLB draws. Like, I think the spikes for listeners,
and they just hit a new high, yeah.
Well, I think the FHLB spikes for listeners out there, I think it was around the normal levels of FHLB borrowing prior to Silicon Valley Bank. I think we're around 300 billion average per month, and I think they spiked up to 1.3 trillion. To put in perspective, and the majority of borrowers were regional banks.
Yeah, I did read there is a SOFR spike a few weeks ago as well, just a brief one. So, and it's interesting because reverse repo, speaking of BTFP, that runs out around the same time reverse repo does, which is in March.
Well, Yellen's
I don't think they're going to actually let it run out, but
well, Yellen's draining everything she can. She drained the Treasury General account. When Biden won the election or stole the election, it was what the Treasury General account was around $1 trillion, I think, when Trump left office, and then it was drained.
It was like 1.1, 1.1, 1.2.
And then he drained it. Yeah, they drained it very, very quickly.
It's draining a little bit faster than than expected, if I'm not mistaken. And I mean, the Fed's got a ton of losses on their balance sheet from that too.
Well, the Fed's actually insolvent. They were paying out like sky high monthly remittance pay. Well, actually, they couldn't do remittance back to the U.S. Treasury. So there was a blog on the St. Louis Fed website about how the Fed they reclassified with accounting rules changes. But the Fed was Joseph Wang, the New York Fed trader, was tweeting about this, I think, in January or February, and he went in detail talking about how the Fed was insolvent and the Fed was paying out way too much in monthly interest payments on interest on excess reserves from the prior quantitative easing programs over the years, and reverse repo. Because reverse repo at one point, I think it was over 2 trillion that the banks and the hedge funds and stuff had parked there at reverse repo.
They had like 2.2 in there, I think.
Yeah.
2.3 maybe.
Well, when you
Yeah.
added it up, it was tens of billions per month in interest payments the Fed was paying to all those reserves and the cash parked there. And so they couldn't then, because it's basically like a business, because you have to think of the central bank as a business, except they don't have to adhere to generally accepted accounting principles because it's a central bank and, they get all these exemptions. But anyway, though, so they were paying out they were cash flow negative. They were paying out tens of billions per month to interest on excess reserves and reverse repo, and they were not able to send the normal 80 billion per year in remittance profits to the Treasury. So the Treasury then was short like over $80 billion per year. So, but there's reclassification. The Fed actually owes the Treasury a lot now.
Yeah, and I mean, yeah, with the reverse repos and of this market, I don't know if you're aware of like how touchy this market has been. We talked about bond market volatility and the Treasury's looking like meme coins. Anybody who's been in my trading room over the last couple of weeks knows I've been constantly complaining about this. I have to normally, when you as a trader, one of the first things you're taught when you're day trading is you never trade during the lunch hour. That's only in the morning, only in the afternoon. You don't want to get caught up in the illiquid mess. And I'm getting frustrated now because at 1:00, I have to be at my desk because the bond market auction, that was supposed to be the most boring news event ever, is moving the market, 25, 30 points every at 1:00, every time there's an auction. This market is
what did it used to do in the past then? So
it used to do nothing. It was like a non-event.
Wow, so things are that dire. I mean, honestly, I don't know who's going to buy the U.S. Treasuries. So, if you just run the math, you said 40 trillion. The debt's going to get to the Fed.
I mean, I'm giving them. I've said. I mean, it's about. It should be, if they don't add to it, it should be like 36. But I mean, come on, like it's Congress, right? It's going to be 40 trillion, right?
Well, it depends what the Treasury is able to roll over the debt or refinance, because I think there's around 8 trillion of Treasury debt that has to be refinanced in the next 12 months. But now that rates are down substantially, it's going to be substantially less than what was projected 6 months ago. But the politicians here in DC, both parties, I mean, that might just give them an excuse to spend more.
Well, I think that's all they care about, and that's why these the bond market volatility is probably going to continue.
Well, also you have China, Japan, Germany, who are the normal buyers of U.S. Treasuries in size over the last couple decades with their foreign exchange reserves, trade surpluses. They're no longer the net buyers. In fact, I think China and Japan are planning on selling. Japan needs to defend their currency. They're probably going to have to sell more Treasuries going forward. And I think China's not. So China, as I've said a lot publicly, I think China over the long term, they'd rather build another strategic petroleum reserve and fill it with oil. They'd rather build new warehouses and fill it to the ceiling with new copper or other base metals. That seems to be the policy that China wants. They'd rather own the commodities rather than owning U.S. Treasuries long term, and gold tonnage, of course.
Well, and Japan, I mean, we talk about the U.S. dollar wrecking ball. If Japan, them defending their currency, that's the real wrecking ball. If that carry trade's ever allowed to blow up, I mean, I don't even know how you would even go about doing the math on the damage that would do.
Well, I think the Fed would step in. I think the Fed would change the rules. Yeah, the Federal Reserve Bank would step in. Currency swap lines, rules changes. I mean,
literally every central bank would have to step in. They'd all have to open swap lines to one another.
Well, they're kind of already doing that. I mean, China's opening up yuan swap lines, smaller ones, but we don't know without actual audits what the Fed's doing with the swap lines with the European Central Bank and others. I know I interviewed Albert Marco. He said the Fed had over 3 trillion of swap lines 18 months ago out, and they're not counting those at all. So probably mostly
Yeah, that's what I suspect was creating a lot of the offsetting a lot of the QT is those other, currency swap lines that the banks are doing to one another. That's just kind of what I suspect is happening.
But Japanese banks, I mean, they have a lot of dollar-denominated debt loans inside the Chinese economy. I found that out from Kyle Bass, and I started researching that more. He said there's way over $1 trillion of dollar-denominated debt loans inside the Chinese economy from Japanese banks. SoftBank's an issue. So I think there's major issues there, whether it's European Union, European banks, Japan, China, the US, emerging markets, Canadian banks. It's just a disaster. But like the asset markets, this is all about the Cantillon effect. I mean, the asset markets, Aaron, seem very, very divorced. Home prices here in the US have not crashed despite the mortgage levels. I guess people aren't selling. But there's a lot of...
Yeah, it's very difficult for them to sell it when they're locked in at 2%.
Well, yeah, who wants to go buy another house with the mortgage, or who can afford it? I guess if you downsize. So I guess you could afford a house, or if you downsize from a larger single family home to a smaller 2-bedroom condo or 1-bedroom condo or something like that, you downsize at a higher mortgage, but most people don't want to do that.
Well, and here's the other thing too. A lot of people are convinced that, we'll just hold off until rates go back to zero. And that's, I think, going to be a bit of a wake up call. As you said, like, there's foreign countries dumping our debt here. Again, I think rates have a secular tailwind, and I don't think that we're going to see that type of low rate environment anytime soon.
So if rates don't go low, what is your opinion of commodities? Because I know you did a recent This Week in Charts, and you were talking about, you think then that 2024 could potentially be a nice bull market for some select commodities, or do you think that they're going to be in a trading range?
I think there will be a point where I think right now they're going to still trade certain things like precious metals will trade somewhat inverse to yields, but at some point that will decouple and they'll start to trade positively, kind of like how happened in the 70s, right? It took that second wave. Like if you look at gold through the 70s, it didn't really do a whole lot until like 75, 76, when that second wave of inflation came in. Now, gold kind of sounds familiar, right? It had the big run up in 2020, and then it's kind of gone sideways to up. I think we could be setting up something like that. But I also think certain other commodities, I've talked about wheat. I like wheat very much so. I think that oil is a little tricky, but I still think there's higher floors in that. I talked about this in This Week in Charts, but palladium, I think that is bottom, and I think that is extremely cheap. I've been looking for that to get down to that 900 area for a while, and I think there's a major bottom in that, and platinum as well. But I think the metals will break out, possibly even this year. I think silver, you're looking at probably 35. That's kind of your next like big secular move. Gold, I mean, there's nothing to say. Once it gets above that all-time high, and on a monthly close, that's kind of what I would look for. I mean, if we close above it for a day, it's done that before. I need to see it sustain above 21, 22. And then, you go to 25 and then 3,000. But this is, the writing's on the wall. I think in the short run, you'll see yields kind of act as a little bit of a cap to precious metals, but eventually that will decouple when people start losing faith in the system. And you're seeing Bitcoin, even Bitcoin, kind of doing the same thing. Like, right, people are losing faith in the system. They don't like where things are going, and they're looking for alternative places to put their money. And I think precious metals will join Bitcoin in that space.
Well, also, it looks like gold is still doing that inverse correlation with oil. And I think we could see something similar play out to oil, to what happened for most of 2023, where it started off the year as weak, and then it had a big rally here on trading range with additional Saudi or OPEC production cuts. So right now, the U.S. oil production in the Permian Basin and some of the other higher cost shale plays have been coming online. Those could sputter out. Iran has increased production a lot the last, I think, 12 to 18 months, but we could see those things start to sputter out, or supply cuts, especially if oil gets back down on the Brent crude price, if it drops below 70. Oil has been range bound though. So I interviewed Samantha Leduc, and I think she said that there was a wide trading range for oil prices around
64.
Between like 60. Huh?
Yep, 64.
Yeah, around 65 and 95.
Yep.
So I wouldn't be surprised if we see a similar range for 2024.
I would think that's true as well. I think that if you get, I wouldn't rule out, especially if we do get, if we do get a slowdown in the economy and there's real fear at some point, I wouldn't rule out a spike of 64, meaning like maybe sub 60. Oil has a tendency to have these panic moves, and there's margin involved, lots of it. And so it can oftentimes, overshoot a little bit. I think if that happens, you buy as much as you can. Because I don't really see, I agree with that floor as a general guide, 60, mid 60s. But if we get a spike, like a panic through that, I would be all over oil at any point, because I think that would probably be a major low. And I don't see oil really going much lower, even if we go into recession, honestly.
There's a production cost issue. I mean, the Saudis need a certain oil price. There's been a lot of currency debasement, higher input costs, a lot of inflation the last 3 to 5 years. The Saudis are not happy at the current oil prices. If they go lower, the Saudis are just going to say, why are we producing more oil? I think we could see additional OPEC supply cuts. And in a lot of the private sector producers, especially if interest rates stay relatively high, I mean, there's not going to be any incentive for the smaller producers, especially the ones that are not publicly traded, that don't have cheaper cost of capital. I mean, they're trying to sell the company now. I interviewed Christine Guerrero about this and other oil experts. I think there's going to be a lot of mergers and acquisitions in oil. On the cash flow multiples, some of these shares are super cheap. So when there is mergers and acquisitions, I think there will be less incentive then to bring on a lot of new supply. They're going to be a lot more efficient at bringing on new supply, and they're going to try to move the cost, move the oil price higher. So we're going to have higher price floors. I think that's what's going to cause the higher price floors.
Absolutely. And again, I mean, we're in a war cycle here. There's wars going on. There's going to be, and deglobalization, protectionism, inflation, that fosters war as much as war fosters inflation. That's not bearish for energy. And I mean, again, it's not something that obviously is a positive or anything that we want happening, but as an investor, you have to understand these realities. And there's just so many secular pressures right now that are very positive for energy prices. And again, that doesn't mean that they can't. I mean, these guys are really good at manipulating. That doesn't mean that they can't keep them from exploding to new highs. But I agree with the higher price floors narrative 100%.
And speaking of manipulation with paper gold prices, I mean, the gold price has not kept pace with the consumer price index. It should be at least 2,300. That was from years ago, before the inflation the last couple of years. Inflation adjusted, the gold price in US dollars should be well over 2,300. That was before the inflation the last 3 years. I mean, we should be over 2,500 CPI inflation adjusted. So the gold price has not kept pace in US dollars. Now, in other currencies, the gold price is doing very, very well. It's the dollar gold price where it's been in a range.
And they're all celebrating the Bitcoin ETF. Just ask a gold bug how that's going to go.
Well, I own gold. I own gold, silver, royalty companies. I own some Bitcoin. So I mean, there's what I take issue with is the people that put all their eggs in one basket. So it's all in on Bitcoin, or it's all in on gold, or it's all in on silver, or it's all in on real estate, or it's all in on some of those Tesla Motors. I mean, there's people out there that do this. I don't know why, but there are.
I know a guy. All he does is trade Tesla and QQQ. He's one of my good friends, good dude, but that's all he trades.
Does his monthly income come in from somewhere else?
He's pretty good.
That just sounds too risky to me. I don't know if I could sleep at night if I was just trading one or two stocks.
I think he does have a real job too. But Dr. Crypto just shouted him out right now. He's going to laugh.
Okay, so if that sounds like it's not his main source of income. Okay, if that's his hobby or his side job, okay, that's fine. I mean, if he wants to do that with his life, I just take issue with the people that they're putting everything into one basket.
Yeah, no, he's not. He's not. He's not one of those just hodler. Every spare cent I get, I put. Yeah, he's just a trader.
So for top performing commodities, you think then that gold and then platinum and palladium, you think could be, if you were to pick maybe the top 3 to 5 commodities that you think will do best percentage wise in 2024, you would say platinum, palladium, and gold?
I would say wheat. I'll say palladium, and we'll go with silver, just because percentage-wise, I think silver would do better than gold.
Now, platinum and palladium are difficult to play. There's not a lot of options because for listeners out there, platinum and palladium are actually byproducts. So they're byproducts of base metal mines. They normally show up with copper or iron ore or nickel mines. Now, there are a few projects. The majority of platinum and palladium mines, for our listeners out there who are not familiar, the majority of global supply actually comes from Russia and Zimbabwe. But there is a very large world-class platinum and palladium mine that's going to come online, I think, end of 2024. The Rothschild family actually is directly invested in the mine. So I don't know how I feel about that, but I guess they are like looking at the project economics with the grades and the costs. And there's big investors too, besides just the Rothschild banking family directly into the Platreef mine, which is owned by Ivanhoe Mines. The stock chart is actually going bonkers lately, even though the mine's like a year away from being finished. And I think Wheaton Precious Metals just bought a large stream on that mine too.
You can own, full disclosure, I own Sprott Physical Platinum Palladium Trust, ticker SPPP. And that's actually a way better way to own it, I think, than the other ETFs or ETNs. The spreads are way better. And I mean, it's owned by somebody who actually has the metal. So there's that. So that's a pretty good way to own. And it has its exposure to platinum and palladium. So kind of kill two birds with one stone. That's a pretty decent way to own it if you're just looking to own the metals and not take any of the extra risk. I mean, yeah, upside is a little bit more limited, but you don't have to worry about a mine collapsing or anything crazy like that.
Yeah, that's true. So you're not taking the individual company risk or the individual mine risk.
Right.
Although, like I said, with Ivanhoe Mines, I mean, the share price, you normally almost never see the stock price in a mine that's a year away from being completed construction, but they just got a big investment from Wheaton Precious Metals on a streaming deal, and the Rothschild banking family is involved. So it's still very shocking, though. The mine's not at least 12 months away from construction completion, and yet the share price is going well. I want to ask you, though, about bull market as we wrap up here, about bull markets, good industries or indexes that have inverse head and shoulder patterns. We're seeing on the GDX and the GoAU, which is the gold royalty and streaming company exchange traded fund, an inverse head and shoulders pattern. That normally means potentially a breakout. Do you think that we could potentially see a bull market in those shares?
I really think that here's the best thing right now that I would say, because I've been kind of cautious on precious metals, more so gold. I've liked silver a little bit more. Obviously, long term has not changed, but I'm more so in the past year. But what has changed for me recently is, as we had that big reversal in gold a few weeks ago off that new all-time high, there was some margin calling and stuff like that. Same thing with silver. But if you look at a chart of, like I said, GDX or GoAU, SIL, SILJ, since that reversal, the miners have made higher highs on the chart. That's bullish. That's something that I have not seen in a while, where the miners were leading the metal during a corrective move. That's definitely a sign that you want to see. That means institutions are starting to accumulate. And again, it doesn't mean it has to happen right away, but that's one of the big things to look for. So I would definitely say that's one of the most bullish things that I could think of right now for precious metals going to 2024.
So for soft commodities, for our listeners out there, we have like cocoa prices, I think cattle herd, orange juice, you mentioned wheat. Does this mean that the farmers are eventually going to have to order more fertilizer to plant those crops to get more crops planted so they can capitalize even more on higher agricultural prices? Or do you think that the fertilizer and potash companies are not going to benefit from the higher soft agricultural prices?
It's interesting. I'm looking at these fertilizer companies like Mosaic. It's a very interesting chart to me. I think that if it does head lower, I don't really see it going below 25. If it ever breaks above 44 again, I think the lows are in, and then the fertilizer companies can go much, much higher. So I'm not as much of an expert on that relation, but I think that they are attractive at these levels. And again, obviously softs. I think wheat is going to 800 a unit and possibly even up to 10. So I would say that's certainly not a bad thing for those companies.
I mean, there's a global rice shortage, there's
Yep.
drought, there's famines in a lot of different areas, bad weather, they're causing crop failures, crop yields are down. From speaking to farmers the last couple of years, a lot of them, when fertilizer prices were high because of natural gas, they skipped planting season, they didn't order fertilizer, so crop yields went down. One would think that eventually they're going to order more fertilizer and plant more, but when the interest rates got raised, from what I heard, this was in the last 12 months as the Fed was raising interest rates, and on the conference calls, the farmers said basically, okay, they didn't want to borrow with debt to go and buy the fertilizer. So basically, like every excuse possible to not
Yep.
order the fertilizer to plant more crops. This is setting up for a food crisis.
Yep. Well, and yeah, and you got Russia is constantly threatening to shut down their fields over there and pipelines that for that matter. Again, it's just lots of geopolitical problems here, and
Well,
again,
didn't Russia, we just saw the article a day or two ago, Russia's selling all their oil to China and India. So, I mean, Russia is still selling a lot of oil. It's just not going to Europe. I mean, European Union's ordering record amounts of liquefied natural gas. So that's going to benefit like Qatar, Norway, the US. Like the US just hit, I think, record liquefied natural gas export volumes.
Yep. Yeah, and they're getting pretty lucky over there. Their winter hasn't been that bad. They dodged a bullet last year, but yeah, gas prices I think will probably rebound here as well in 2024. It's nat gas. That's the widowmaker. But I don't really see it getting much below where it is right now. It's had kind of similar, collapses in the past, and it does this thing where it, gets stuck in a trading range. But at any time, I mean, some geopolitical stuff can set that off too. So I mean, that's another interesting dynamic there. But it's like I think you said in a previous podcast, it might have been with Elliot Q. It's like everybody's talking about, oh, we want to increase our natural gas consumption, but nobody wants to produce it. They just want to import all of it.
Yeah, there's drilling that. There's literally all those countries they're putting the press releases out. Oh, we're going to build this super expensive, super fancy liquefied natural gas import facility. And it's like everywhere there's drilling bans. All
Well,
those places are.
Yeah, you could have spent the same amount of money to actually do it yourself.
Well, I mean, I guess it's good for the U.S. for liquefied natural gas exports, where those firms that were able to get cheap debt and start construction before the Fed started raising interest rates, they're going to be building out their liquefied natural gas export facilities. Qatar is going to benefit. Norway is going to benefit. But those countries are going to be and maybe Australia to a lesser extent, but the rest of the world is not getting the supply, or there's going to be a fight over it at higher prices for the supply coming from those exports.
Yep, 100%.
Okay, well, one more question before I let you go. So I want to get your thoughts on uranium. So I honestly think uranium is overdue for a pullback here, but I think there's definitely a long-term bull market, especially like if the Davos crowd they're going to do what they say, and they're actually going to make the investments into nuclear power, and they're actually going to follow the steps and allocate capital towards tripling nuclear energy capacity in the coming decade. So if that is true, if they're actually going to do what they say and make those investments, then I think we are going to have a long-term uranium and nuclear power bull market. But it seems that like those shares are way ahead of themselves right now.
Yeah, we've been talking about this. I mean, and it's something I mentioned about specifically Camco. A lot of fund managers didn't make their benchmarks this year. They're chasing. And again, I thought Camco was overbought at 37, and it got all the way up to almost they got to 47 just about. So it's just been it's been in a parabolic mode. It will correct. It does need to correct. The price of uranium does need to correct, but that's commodities. That's what they do. I like the URNM a lot better on the charts. I think it has a nice consolidation pattern. I think that broad ETF of broad miners looks a lot better here. It's not seeing that FOMO. It's a lot more balanced way and to get exposure. It's also eliminating single company risk too. But yeah, in general, the price does need to come down. I mean, it's a little absurd here. And it is due for a correction. I'm taking a look here at uranium. Yeah, we're at 91.25. 4 months ago, we were at, about $50, maybe a little bit higher. So it's definitely taken off here. I mean, we're at multi-decade highs. We got to go back to 2008 for the price of spot uranium. But I mean, hey, nothing to say it can't go test 100. I mean, when you go parabolic like this, Who's to say when it's going to stop? But it does need to pull back at some point, though.
Yeah, it was getting kind of Cameco shares were getting kind of parabolic. I mean, I remember when
Yeah.
Cameco and you were doing This Week in Charts videos the last 12 months, every time Cameco would have a rally and a little pullback, people would panic. How dare you talk about Cameco? It's not going to rally. It's over. There's not going to be a bull market. I mean, it's exactly the quote from Sir John Templeton that bull markets are what they're built on pessimism, they rise on skepticism, and then what it is optimism and euphoria towards the end.
Top on euphoria. Yeah. Yeah. I mean, it's right. But where were they, Jason? You and I were talking about uranium in 2020 and 2021 when Cameco was like $10. And we were saying, hey, the bear market's over, and nobody wanted it. Now, if you say, hey, it's due for a pullback, I'm not even saying I'm bearish. I'm just saying it's due for a pullback. People freak out.
Yeah, and then it got to 20 or 25, and people like, okay, it's over. The rally's over. It's going to crash. I mean, there was a lot of that too. Every time it would have a rally and a pullback in the last 3 years, there was a lot of people like that. Like, I'm out. I'm out. How dare you say anything good about uranium or nuclear power? It's like, well, eventually it was all these politicians and bureaucrats in all these different countries that were wasting probably trillions of dollars with negative return on investment on wind, solar, biofuels, and ESG. So that's the main reason we're going to have a bull market in the non-ESG energy is all this money was wasted on the ESG stuff.
Yep. And again, I maintained all throughout 2022 and early 2023. I said, look, these uranium stocks they're just consolidating. They moved from $10 to 20 in a year, and they're just consolidating. They're going sideways. There's nothing wrong with that. They're just digesting the gains, and now you're seeing this big bull run. So sometimes it's best to just zoom out, and you don't worry about if you're investing in the long term and you're freaking out because your stock is down 2% today. I mean, I'm telling you, you're not going to make it.
So as we wrap up here, any sectors or industries you think will have a big rally in 2024 or a bull market? I'll go first. So this is off the charts here because I don't really talk a lot about tech or stuff like that. But this sector's been in a bear market. I think there's consolidation, free cash flow. If you look at the news headlines, these companies are actually getting deals done. They're getting a lot of contracts and deals done. They're trimming the fat. Cap with the higher interest rates, cost of capital is not available. So there's mergers and acquisitions. I'm going to say 3D printing. I'm going to be a contrarian. I'm going to say these 3D printing companies by the end of 2024 think they're going to be substantially up from where they are now. I think 3D Systems, Triple D, I think it got down to like $3 or $4, and it's already rallied up to around $6 now.
Interesting. So I know I've said it before. I'll go with wheat again. I think that's going to go much higher. A couple of sleeper sectors, well, maybe not sleepers, but keep an eye on the marijuana stocks and keep an eye on psychedelic stocks. We are going into a general election year. Those will likely perk up towards the election again. Doesn't mean they
wait, what do you mean? What are those like the mushroom, the legal mushrooms where people are microdosing?
And mushrooms and the MDMA and the microdose. Yep, those names.
And last but not least, honestly, if gold prices, the US dollar gold price stay at these levels, you have the royalty and streaming companies other than Franco-Nevada. And I really believe Franco-Nevada will fix the problems in the next 6, 12, 18 months.
Franco-Nevada, I'll give you this right now. Franco-Nevada is a buy right now.
If I had to bet on one stock that would have a good rally the next 12, 18, 24 months, it would be Franco. I think they're the safest to have a nice rally.
And it's so cheap right now. I mean, you take it, everybody's all mad. Oh, it's correcting. This is when you don't get mad, you just buy it. I mean, the market's giving you an opportunity here. So, if you like the company, I don't know why you wouldn't want to buy at these levels.
Yeah, I think risk reward, I think the upside's 30 to 50% in the next 12 to 18 months if more of those deals that Adrian Day, the gold fund manager, Adrian Day, who, by the way, Peter Schiff at Euro Pacific Capital had to hire to fix his gold stocks. So Adrian Day knows what he's talking about. He's done very, very well. I'm not going to say the exact numbers, but he's done very, very well on these royalty and streaming companies for decades. He's made his investors and himself a lot of money on these royalty and streaming company stocks. But I think Franco-Nevada risk reward is very, very safe. But these earnings, Aaron, for these royalty and streaming companies, the mid-tier ones, which are, I think, at all-time low valuations on cash flow multiples, the larger ones, the low-cost gold miners, especially if energy prices stay at these levels or go down and gold prices don't crash, the profit margins, the free cash flow, over the next couple of quarters, the earnings are going to be super robust for the low cost gold miners and also for the royalty and streaming companies. And none of this stuff is priced in yet.
And a lot of, and again, and it comes, we haven't even seen hype yet. So, I mean, gold is, when gold actually sustains above the all-time high, then you'll start to see hype come in, and then it'll be all over. I mean, you remember you were trading with me in 2011 when there was these companies you never heard of. It was like gold stocks were like the old tech stocks. Like it was,
I made 500% on some of these juniors. Yeah, I cashed
like the
out
pink
of a
slips.
few.
Yeah, the pink slip goldtech.com or something like that, and it would go up like 500%. There was hype back then. We don't even have that yet. Like you guys who haven't been trading, like this is not hype. Like you will see.
Well, there's no capital available. There's no capital available for juniors. I mean, there's not going to be a lot of survivors. A lot of the juniors, I would ignore what a lot of the juniors are saying publicly, unless you can go and look up how much cash the juniors have on the balance sheet and how much cash burn they have for for management salaries or drilling. A lot of these juniors, I mean, they can't raise capital right now. So they're on the phone. They're sending out emails. They're not going to talk about this publicly for the most part. They're trying to sell the company now.
I don't think that they need to be good. If you have enough hype, people will buy anything.
Oh, well,
I'm not necessarily saying they're good. I'm not saying they're good companies, but that's kind of how it works.
Well, at some point, yes, but I'm just saying, I interviewed Jordan Roy Byrne from the Daily Gold, and he basically said that will happen once gold gets to like 2,500, 3,000. So he doesn't think that will happen anytime soon. So he said it's going to take a while for the gold price to get above 2,300. He thinks it could be closer to 2,500, 3,000 range before those juniors start to get like those types of big gains, like you said. But I mean, like until we get there, a lot of these juniors can't raise money. I mean, like they're not going to say this publicly, but literally, like they're on the phone, they're sending out emails, they're trying to sell. There's already been like sales where some of these juniors have sold out like 70% of their property to a larger mining company that's already producing. So they're already trying to sell. There's a bunch of those the last 6 to 12 months.
I mean, it's easily the toughest business there is, and then you add and a historic interest rate increase. It's very tough for those companies right now.
Oh yeah, those are kind of junk, but they're call options on a higher metals price. But with the cost of capital at these levels, I mean, those will turn on to risk on at some point. But until we get there and the generalist investors and retail investors start getting interested in those, there's no capital available. So
it's a call option that doesn't expire, essentially.
Well, unless the company runs out of funds.
Unless the company goes bankrupt. Yeah. Oh, they could get bought out. You never know.
Yeah, well, if they get bought, it's not going to be at a big premium. I mean, like I don't think we're going to see what Kinross did with Great Bear Royalty 12 months ago. They paid like Great Bear didn't even have a feasibility study.
Yeah, market was not too happy, if I remember correctly.
Well, but there's a reason that Kinross did that. So if Kinross had let the Great Bear get to a feasibility study, they had no mathematical chance in terms of dollar amount, cash on the balance sheet, or even debt or anything for winning a bidding war with Newmont Mining or Barrick. So that's why they did the bidding war. That's why they bought it when they did, because it's just like some of these royalties. I mean, if they get to a certain stage, Franco-Nevada can outbid everyone. So it's like that with a gold mining deposit. So if it gets to a feasibility stage, who's going to beat Barrick Gold or Newmont Mining in a bidding war?
Right. Nobody. Right.
Yeah. So, I mean, if the largest player in the industry decides they want to buy something and they're in a bidding war, they're not going to lose the bidding war. So that's why you're seeing these firms. For our listeners out there, if you're not familiar why these firms like Royal Gold bought the Great Bear Royalty before the feasibility study, or Kinross Gold bought the mine there at Great Bear up in Canada before the feasibility study, that's why. So they did it because they know that mathematically they had no chance to win a bidding war once it got to a feasibility study.
Yep.
So I think 2024 will be another volatility roller coaster. The VIX is not reflecting that, but if we do have a Volmageddon, Aaron, I think things could get very, very ugly for banks and hedge funds. We could have, with the leverage short volatility trade, we could have a blow up.
And with zero DTE, we haven't seen real volatility come into play with zero DTE yet. So we haven't really seen that unleashed. Like we've seen it keep the market afloat, but if there's an actual panic, that could increase volatility to the downside. Absolutely.
And we're going to have people like complaining that you didn't say anything on Bitcoin. Honestly, as long as there's currency debasement for other currencies, and I think there's rumors of the China hedge fund managers, China newsletter writers, experts I talk to, they think a pretty large yuan devaluation, another one's coming in the
I-
next
I'll
6 months.
I'll say
I,
this for Bitcoin. Oh, go ahead.
well, I was just saying that I think a lot of the reason Bitcoin's done well, and you don't hear this on business television, I think it's currency debasement in the other currencies. So
In China.
Americans are dollar cost averaging and buying it, but I think it's a lot of foreign buying. I think a lot of people are worried about other currencies outside the dollar. So if you're in China or Turkey or Venezuela, emerging market country where your currency has been debased a lot against the dollar, I mean, what are your options if your government has strict capital controls? I mean, what you can buy some gold or silver, or you can buy Bitcoin. So there's not as many investment options for a lot of foreigners as there is for Americans.
100%. Because I mean, Americans are always dollar cost averaging into it, and the price still went in a bear last year. So yeah, I think foreign demand definitely plays into it. I know there's a lot of hype right now with the ETF. My thought on that is I'm going to give. I think Bitcoin get to 48, maybe 50. I think it'll probably have now. It's had a really good run, and it probably needs to correct. But I think it's going to hold up until that ETF gets approved. When it gets approved, you'll get like a big pop, and then I think it'll start to correct. That's just kind of how it works when you run up into these volatility events or news events, and everybody knows the outcome. I mean, like it's kind of a sell the news. But
Well,
that said, Bitcoin's holding up fine, and I mean it has room to correct and still be in a bull market.
what's funny, I don't know if you saw this, but like Perianne Boring from Chamber of Digital Commerce, who I'm friends with, was on business television, Fox Business, earlier today. And she was talking about like this ridiculous legislation that Elizabeth Warren and other senators and people in the House are trying to pass. And basically the bankers are influencing them, and it's like trying to get Bitcoin banned. It's ridiculous. It's that they haven't even read the legislation. So the stuff they're saying in public doesn't jive with anything in the bill.
Well, if they ban it, then a lot of congressmen are going to be unhappy because they're trading it too.
Yeah, and their aides are trading it. Yeah, well, oh yeah, they talk
Yeah.
at the charity events and the fancy parties here. I mean, there's a ton of people here in the DC metro area that are trading Bitcoin and crypto. I mean, I saw pictures on Twitter. There were people that were like Federal Reserve Bank employees, the younger ones that they were hiring, the interns and the younger ones that are fresh out of college. They were trading crypto on their phone too.
Yeah.
Wow, what a wacky world we live in. So I think 2024 is going to be another crazy. It's going to be more, I think, unfortunately, stagflate, tax lie, and the mainstream media is going to talk about deflation. But like you said, I think we could have another wave of stagflation and inflation, very similar to the 70s. And it's going to be. I don't think they're going to let, even if the asset prices crash, I don't think they'll let them stay very low for long.
Yeah, I don't. Again, they can't tax deflation, and they're all celebrating the dollar coming down right now. But the dollar coming down just causes us to import more inflation. I mean, there's just too many tailwinds here.
Well,
This this
the DC doesn't want a strong dollar, so they want the
right,
dollar in a
exactly.
range.
Yeah,
I
yeah,
mean, like, so I'm friends with Brent Johnson. I've known Brent Johnson for over a decade, and I've interviewed him. He's predicting like the super spike on the dollar index. I mean, that collapses the whole system. So I
right.
don't think they'll change the rules. They'll do backdoor bailouts, liquidity programs. They'll issue currency swap lines and then waive the loans. They will not let the dollar raise to those levels. I mean, they could just do a Plaza Accord 2.0. That's the main reason they did. I think the Plaza Accord, what, in 1985, is the dollar was too strong and it almost collapsed the system then, and they had to do a one-off devaluation.
I mean, I could see it. I could see it trying to do that. I just don't see it spiking for very long. I could see that scenario. I know I'm familiar with it, but you're right. It wouldn't be allowed to last. But I could
Oh
definitely
yeah,
see that thesis. I could definitely see the thesis play out, though.
well, we've kind of already had a mini dollar milkshake. Again, we had another one. What for a lot of 2023, there was money coming into the Magnificent Seven and money market funds, short-term U.S. Treasuries. So I would say there was already kind of a mini dollar milkshake with the liquidity flows from other countries, minus the big spike in the dollar. I think the goal here from the policymakers at the Federal Reserve Bank, Treasury Department, the other policymakers in DC, they want to keep the dollar in a trading range, not too high, not too low. If it gets too high on the trading range, say it gets up to, I don't know, 110, 112, That's what Albert Marco said. I mean, at dollar index 120 or above, that's like margin calls, bank collapses, derivatives failures, interest rate swaps failing. I mean, that's like anything around 120 or above is like big time margin calls and potential bank or hedge fund failures, in my opinion. And they don't want it. They don't want the dollar too weak. So there's stuff that the Fed can say, oh, we're going to raise rates. Oh, we're going to fight inflation. Oh, we're going to sell less treasuries. There's stuff that they can do to keep it in the trading range. So like dollar too strong, people. I'm in the dollar tug of war camp where basically they've kept things kind of in a trading range for a long time.
Yep, they're just it's balancing this game with all of our 401ks.
Well, most people don't notice the real inflation. I mean, like who here, you can comment in the comment section below this video here, who actually believes the consumer price index is accurate. I mean, it was saying a month ago that our healthcare insurance was down 34%. I mean, that doesn't reflect reality at all. It's just a bunch of adjusted garbage.
And even I mean, there's food items. There's a report that came out. Most food items are up between 20 and 50% in the last couple of years. I mean, but we have to, the Fed cares about, certain items and their, personal spending, but, not the things that people need. Like, what was that I sent you the other night? Housing prices up for the 9th straight month. The most valuable asset is up for 9 straight months. And I'm supposed to believe that deflation is the big boogeyman here. I'm sorry, but that's just really hard for me to believe.
Well, if they allowed bankruptcies, if they allowed the banks to fail without like BTFP and all that stuff, then yeah, we would have probably had a short amount of deflation temporarily, but they didn't allow that.
Right.
Okay, well, I want to thank everyone for listening to our 2023 review and 2024 preview. I hope you got a lot out of this. If you have any other questions or comments and you're not trolling, you want to ask a thoughtful question below the video, comments and information section. I think a lot of consumer spending is headed towards online. So I think cybersecurity, but the valuations on the cybersecurity stocks they're just really, really high. Now, if there was a stock market crash or correction, maybe Hack or some of those cybersecurity companies would be a good buy. But right now, like they've just been on fire lately.
I definitely can't argue with that.